Our next topic is on deferrals. These will be a little more complicated than the accruals because most of these transactions you have not done already. The two deferrals are unearned revenues and prepaid expenses. We will begin by covering unearned revenues first. Unearned revenues are when cash is received in advance of providing the product or service. Examples include rent, airline tickets, and customer deposits, to name a few. Think of an airline. Don't you have to purchase your ticket before your flight? Yes, we all do. We cannot pay after the flight, but we have to pay before. Airlines consistently have unearned revenues. If you purchase a ticket and pay the airline still has to provide you with the service. I brought this up last chapter briefly, where unearned revenue accounts are liabilities. The airline's work is not done. They still need to pay pilots, attendants, maintenance workers. They still need to clean the plane and purchase fuel. If the airline cannot do this, they will need to give you your money back. Here is the same timeline. For deferrals, they will work opposite of accruals. Accruals have the revenue or expense first, with the cash later. Deferrals will have the cash first and the revenue or expense later. Remember, we are not concerned with the cash transaction. When journalizing adjusting entries, we are concerned with either the revenue or expense entry. First, we will receive cash early. At a later date, we will provide the service or product to the customer. This is when we record it as revenue. It is not revenue when we receive the cash. It will be revenue once we complete the sale or service. This adjusting entry involves debiting an unearned revenue account and crediting a revenue account. This is a little confusing because we are concerned with the second entry and not the first. The first entry, when cash is received, would be a debit to cash and a credit to unearned revenue. Unearned revenue is a liability account and has a credit balance. Therefore, when we receive the cash, we will put the liability on our books. Now, fast forward to the second entry, when we provide the service. We no longer have a liability. Once we complete the sale, we no longer owe anything to the customer. We will remove the liability from our books by debiting the liability account called unearned revenue. We will credit a revenue account because we can now officially include the sale as revenue on our books. Next, we have prepaid expenses, which is even more complicated than unearned revenue. This is because there are a few different types of entries here. We will cover 3 different examples. Prepaid expenses are when cash is paid in advance of receiving their benefits. This business will pay for an expense and it will be used later. Examples include prepaid insurance, prepaid rent, supplies, and depreciation. Looking at the timeline, we first pay for the expense or asset. Later, we use it. When we use it, that is when we will recognize the expense on our books. The adjusting entry involves debiting an expense account and crediting an asset account. We debit the expense account to put the expense on our books, and we credit the asset account to reduce it by what we used during that time period. Our last adjusting entry for prepaid expenses is depreciation. This is a very important topic to learn. Even if you decide not to go into accounting, depreciation is something you may still encounter in your business career. Now, depreciation may mean something different than what you are used to. Most of my students think of depreciation as the decrease in value of an asset. For example, your car. Your car depreciates in value over time. In accounting, it is similar, but not quite the same. We are not revaluing the asset. Instead, we are expensing the amount we paid for that asset as an expense over its useful life. In Chapter 10, we cover this in more detail, along with the different methods. When we buy an asset, say a car, we put the car on our books for the full amount we paid. We will expense what we spent on the car over several years. We do not expense it all in 1 year because we're using it over many years. I will probably expense a car over 5 years. For now, we're going to learn one way of calculating depreciation, which is the straight line method. We will learn the other methods in Chapter 10. The straight line method is taking the cost of the asset, subtracting the salvage value, and dividing by the useful life. These numbers will all be given to you. You just need to do the math. The salvage value would be what the asset is worth at the end of its life. If it's worth anything at all, we don't just throw away the car or leave it on the side of the road, we will sell it. When we use this formula, we will be able to calculate the depreciation expense for a year. There is a lot more to this topic that we will cover in Chapter 10, but for now we're just keeping it simple by calculating depreciation for a full year. Now, normally in class, I play you another YouTube video that goes over depreciation a little bit more. I included this link after this video. The adjusting entry involves debiting depreciation expense and crediting accumulated depreciation. Now, let me give you an example before we practice on what this all means. Let's say we purchased a car for $60,000. We will use the car for approximately 5 years before purchasing a new one. We are estimating that the car will be sold for $10,000 at the end of the 5 years. We will use the formula to calculate the depreciation expense each year. We will take the cost of the car less the salvage value divided by the amount of years. It would be $60,000 minus the $10,000 divided by 5. This will equal $10,000 of depreciation per year. Depreciation expense will be debited each year until the full amount of the asset will be expensed. We will record depreciation of $10,000 each year for 5 years. Now the credit will be this new account called accumulated depreciation. This account is a contra asset account. A contra account means the normal balance is on the opposite side. Since assets have a normal balance of a debit, the accumulated depreciation account has the opposite normal balance of a credit. It is still in the asset section though, but will reduce the value of that asset. The two accounts are linked together. We have the asset on the balance sheet for $60,000. Below that, we will have the accumulated depreciation account. This account will just keep accumulating the depreciation amount each year. After 1 year, the accumulated depreciation will be $10,000. The second year will be $20,000. The third year, $30,000, and so on. The value of the asset on the balance sheet will be the book value. That's what this is called. After the first year, the book value will be $50,000.